did I learn about private money. I had never heard of it, didn't know what it was. And that was like the holy grail. I was blessed to be able to raise $2,150,000 in new funding available from individuals to fund my real estate deals. And a big secret to that is when I did that, and since that time, I've never pitched a deal. I've never asked anybody for money. All I did was put my opportunity together as to what kind of interest rate I'm going to pay, what's the length of the notes, the frequency of payments, how they can get their money back in case of an emergency. Most importantly, how they are protected.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Ladies and gentlemen, thank you for being here listening in. Today, I have a wonderful guest here to talk about something that is where you turn to when all of the traditional strategies and ways to invest in real estate, I'll say, aren't available. I've got Jay Connor here, a seasoned investor who built a seven-figure business after being cut off by traditional lenders during the 2008 crash. And what I think is really cool about this is because although Jay is going to be talking about strategies and getting to some of the details, it's really a testament to getting resourceful. Right? Getting resourceful, not just the resources that you have, but who can you talk to? What can you do to go out and actually make things happen? So, Jay, welcome to the show. Would you please introduce yourself to the listeners and let's get into that story? You're also kind of teasing me before we turned on and hit record here about something that's going to tie in well to what I have going on, what the show has here. So I'm very interested to hear about that.
Steven, thank you so much for inviting me to come along and talk about what I'm so excited about and I'm so passionate about, and that's private money, private lending. And the reason I'm so passionate about private money and private lending is because this is the number one top shelf strategy that not only saved my company, but projected my company to earning 3 times as much money in the first year that I started using private money. So how did all this come about, Stephen? My wife, Carol Joy, she's from Texas. That's where you're living now, in Austin, Texas. My wife, Carol Joy, and I, we started investing in single-family houses in 2003. I'm not sure you were born in 2003, Stephen, but anyway, we started.
I was.
So we started in 2003. First year, we only did 3 houses, 3 flips. We started flipping houses before HGTV was even, before it was a thing, you know. And so here's what happened. From 2003 to January of 2009, those first 6 years, the only thing that I knew to do, and I'm here in Eastern North Carolina, we've rehabbed and flipped over 500 houses now. The only thing I knew to do those first 6 years to fund our real estate deals is go to the local bank. I had a line of credit at the local bank, also did some business with some mortgage companies. And that's all I knew to do to get funding for my deals. And let me tell you something, Stephen, everything changed. In January of 2009, I called up my banker. His name was Steve. Believe it or not, we actually still have handsets and cords here in North Carolina. But I do have an iPhone. But anyway, I called up my banker. His name was Steve. He'd been funding, the bank had been funding my deals for 6 years. And I called him up in January of 2009. I had 2 houses under contract to purchase. Stephen, I thought I still had a line of credit at the local bank, or I wouldn't have given that earnest money. Back then, you couldn't get your earnest money back. So I called up Stephen. I told him about these 2 deals I had under contract. And Stephen, I learned like that over the phone that I didn't have a line of credit. My line of credit had been closed.
Yep.
And I said to my banker, I said, Steve, what in the world are you talking about? Why have my lines of credit been closed? I got a great credit score, never been late on payments for 6 years. What are you talking about? And Steve said to me, he said, Jay, don't you know there's a global financial crisis going on right now? I said, no, Steve, but you just gave me a financial crisis. I don't have a way to fund these two deals. So I hung up the phone and I sat right here, Stephen, sat right here. And I asked myself a very powerful question that changed the total trajectory of our company. And here's the question I asked myself. I said, Jay, you're getting ready to find out how this ties into what you got, Stephen. I said, Jay, who do you know that can help fix your problem? I'm looking at your book on your shelf right behind you that says who, not how, right?
Yes.
Dr. Benjamin Hardy, I think Dan Sullivan.
That's the one.
And I didn't know about that book. I don't think that book existed in 2009. But it's not what you know, it's who you know that can help you. And when I ask myself that question, who do I know that can help me fix my problem? By the way, these people running around saying every problem's an opportunity, I want to throw up. I didn't have an opportunity. I had a problem. Now, the problem became an opportunity over time because I wouldn't be here with you on your show unless I'd been through this experience. And you know what's interesting about powerful questions is when I ask myself, who do you know that can help fix your problem? And by the way, that question will help fix any kind of problem, career, relationships, health, financial, whatever. When I asked myself that question, I immediately thought of a dear friend, Jeff Blankenship. He was living in Greensboro, North Carolina at the time. Carol Joy and I know him and knew him through church and a cappella singing events and that type of thing. Jeff was investing in single family houses in Greensboro, North Carolina at the time. I called him up and I told him what had happened with my conversation with Steve, my banker. You know what Jeff said? Jeff said, Jay, welcome to the club. I said, I'm not sure I want to be a member of that club, but what are you talking about? He says, my bank cut me off last week. And I said, how are you going to fund your deals, Jeff? He said, have you ever heard of private money and private lending? I said, no. He says, have you ever heard of self-directed IRA companies where an individual can take current retirement funds, move them over to a self-directed IRA company with no tax effect, no tax penalty, and then they can loan that money out to us real estate investors, and the interest that we pay them is either tax deferred or tax free, depending on the type of account they've got. I said, Jeff, man, you're talking Greek to me. I don't have a clue what in the world you're talking about. I said, what's private money? He says, I'm not actually sure, but there's a gentleman down in Jacksonville, Florida by the name of Ron LeGrand that says he can teach us about private money and how to do that self-directed IRA strategy. I said, but what is it? Jeff says, Jay, I told you, I don't know, but Ron LeGrand says we can get a lot of it really fast. So Jeff and I went to Ron LeGrand's conference to learn about private money. That was in February of 2009. And oh, my lands, did I learn about private money. I had never heard of it, didn't know what it was. And that was like the Holy Grail, the Holy Grail. I came back home, Stephen, and I'll share with you here in the show how I did it. But I was blessed to be able to raise $2,150,000 in new funding available from individuals to fund my real estate deals. And a big secret to that is when I did that, and since that time, I've never pitched a deal. I've never asked anybody for money. All I did was put my opportunity together as to what kind of interest rate I'm going to pay, what's the length of the notes, the frequency of payments, how they can get their money back in case of an emergency. Most importantly, how they are protected. I give them all the same protection as the local bank. I do not borrow unsecured funds. So I put that opportunity together. And then what I did, Stephen, is I just went about, during my daily life, first of all, diagnosing if people in my network have a problem. Now, here's a writer downer. The definition of malpractice is giving a prescription before a diagnosis.
Nice.
So I didn't go around throwing up on people about my wonderful investment opportunity. I just went about diagnosing people in my network if they weren't happy with their returns. Were they sick and tired of the volatility of the stock market, et cetera? And if they were happy with their investments, then that's fantastic. Then I want them to tell me about their investments, how I can get involved.
You got something to learn. Yep.
My very first private lender luncheon that I invited about 20 people to, and had my CPA and my attorney and my realtor there, I raised $969,000 just at that one luncheon without having any deals attached to it. Steven, I'm going to take a little risk and ask you a question, and then I'm going to hand it back to you. I think I know the answer to this question, but have you ever heard the guru or somebody stand on stage or whatever or wherever and say this? Oh, just get the deal under contract. The money will show up.
Yeah.
Lands. Or they'll say, oh, money finds good deals. Money finds.
Yeah.
Again, I want to throw up. Has money got legs running around looking for deals? You get a deal under contract, is a drone going to fly over your front door and drop a bag full of money?
Not yet.
Give me a break.
Not yet.
It just seems to me to make sense to get the money lined up first and then think about how many more offers and confidently you're going to make once you know where the money is coming from first. That just seems to make sense to me.
Getting your partners together is just good business.
And so here's the secret sauce from the standpoint or the perspective of the real estate investor. You got the money lined up. So here's the mindset. Put on a teacher hat, which says private money teacher, right? Private money teacher, to where I'm not asking, begging, chasing, selling, persuading. I'm teaching, and Carol Joy and I have had 47 individuals, regular people, ordinary people that had lazy money that was not working for them, either investment capital or retirement funds. Here's the interesting thing, Stephen. Not one of them had ever heard of private money. None of them. They hadn't heard of private money.
Yeah, why would they?
They didn't know what it was. They never heard of self-directed IRAs. Over half of them have used and are using their retirement funds. And the interest we pay them is tax deferred or tax free, depending on the type of account they've got. So here's the secret sauce from the standpoint of a real estate investor wanting to borrow private money. And that is, never talk about your opportunity, how to get high rates of return safely and securely, and you got a deal that you need funded. The worst time to be raising private money is when you need it.
So never be talking about it. Do you mean, expand on that? Do you mean on anywhere, one-on-one conversations with people? Definitely not putting it on, making Facebook ads, Jay, putting in newspaper, signposts. What do you mean by that?
Desperation has a smell to it. And so if I'm talking, so Stephen, let's say I'm having a coffee with you and I'm talking to you about my private money opportunity. And in that same conversation, I talk about this deal I've got under contract that I need funding for. I'm begging. And I'm not even
Right.
trying to. So all my initial conversations with a potential private lender from my networking connections,
Is
I'm
diagnosing, like
diagnosing.
you're saying, right?
And then I talk about the
Mm-hmm.
opportunity and the interest that we pay and et cetera, and never bring up a particular deal that needs funding. So once they like it, they want to do it, they want to get involved, then I simply say, I'll put your money to work for you just as soon as possible. And then in a couple of weeks or whenever, I call them up with the good news phone call.
The good news phone call. Yeah, this is where you finally got the deal. So up until that point, you're just saying the types of things that you do, but nothing specific.
Nothing
Is that
about a
right?
specific property. So like, I'll share with people, I'm not going to borrow more than 75% of the after repaired value. I didn't say 75% of
Mm-hmm.
purchase price, but we're going to give our private lenders a 25% equity cushion based on after we renovate that property and it's in great condition.
Mm-hmm.
We've been paying ever since 2009, I've been paying our private lenders either 8% or 10%. And they love it because the only thing they
Great.
had to compare to that was what they could get at the local bank. Right now, that's 0.02% in a savings account. And if you're lucky, you might can get 3% APR, but they're only going to give you 4 months because
Mm-hmm.
the rates are continuing to come down. So they know the interest rate. They know how they're protected. They know I'm going to give them here in North Carolina, it's a deed of trust. Most states call it a mortgage, but I'm going to give them a deed of trust to collateralize that note. They're going to get the same protection as the local bank gets. They're going to be named on the insurance policy as a mortgagee. So if there's ever a claim against that insurance policy, the insurance company is going to make that check payable to them, the private lender, and to my company. They got to sign off on that check. We're going to name them as an
Mm-hmm.
additional insured on the title policy. So they know all that stuff before I call them up with the good news phone call. So if it's okay, Steven, I'll share with you and your audience what's the script.
Share the good news.
What's the
Let's
script?
go for it, Jay.
Steven, let's do a couple of assumptions. Let's assume, first of all, that you and I know each other. We've known each other for some time. We're friends. Maybe we go to church together. I don't know, but we know, like,
Mm-hmm.
and trust each other. And I've shared with you the opportunity with no deal attached to it. You like it. And you have told me that you have a $150,000 401k at a previous employer that's just sitting over there collecting dust, right? It's not doing anything,
Mm-hmm.
not going anywhere. So I've shared with you the opportunity. And let's also assume that I have introduced you to my self-directed IRA company that I recommend, and you've moved that $150,000 retirement funds, that 401k, you've moved it to the self-directed IRA company, no tax effect, but now took a couple of weeks for your account to get funded. So now that money is sitting there and you're waiting for the good news phone call. So I call you up, you answer the phone, we have a little chit chat, and then I say, Steven, I got great news.
What's the good news, Jay?
I can
What you
now
got going
put
on?
your money to work. I've got a house in Newport under contract with an after repaired value of $200,000. Now, the funding required for the deal is $150,000, which matches up to what you have at the self-directed IRA company. Now, closing is going to be next Thursday, so you'll need to have your funds wired from your account, the self-directed IRA company, to my real estate attorney's trust account by next Wednesday.
Mm-hmm.
I'm going to have my attorney email you the wiring instructions. That's the end of the conversation. The most stupid thing I could do is ask Steven, do you want to fund the deal? Of course, Steven wants to fund the deal. And there's 3 big reasons why Steven wants to fund this deal. Number one,
why is that?
You trusted me and moved your $150,000 over to the self-directed IRA company. Number two,
Got you.
I'm not going to bring any deal for you to fund unless it matches the criteria, the underwriting criteria that I already shared with you and taught you. I
The
mean, I told you
opportunity.
the
Yep.
after repaired value is 200,000 and the funding's 150,000. That's 75% of the after repaired value. And the third reason that you're dying on the vine to fund my deal is because you're not making any money. You're not making
Exactly.
that $150,000 that you moved over to the self-directed IRA company. It's just sitting there until I perform and I fulfill my promise of putting your money to work. So,
yeah, lazy money.
That's it.
No good. Yeah, that makes a lot of sense altogether on that, because one of the things that I really wanted to dive more into, and we'll get to, is why is that such a good deal for the investor, right? In this case, you're talking about how the money that was moved from a previous employer's 401k got rolled over to a self-directed IRA, and now nothing is happening with it. And it's like, I mean, there's this opportunity. It fits what you've talked about, what Jay's talked about here on the underwriting, the buy box, so to speak. The investor has been educated. I've been educated here on this, right? And it makes sense. It makes sense. It seems like everything is lining up and I can put my money to work. And so kind of recapping that whole thing, this whole structure can work and exist because, you had to be resourceful, and you talked to your friend Jeff at the time, if I remember his name correctly, to go and learn about private money because you couldn't get it from the banks. And whether or not, correct me if I'm wrong here, Jay, but whether or not someone can go get money from the banks, this can still work.
Absolutely.
Right?
Absolutely. And by the way, I want to make this distinction while I'm thinking about it. When I say private money, I'm not talking about hard money. Okay. So let me do a little distinction here. Most of the time, a hard money lender is institutional money. It is it's a brokerage. It's a brokerage to where the hard money lender, and by the way, I'm not poo-pooing hard money. Some of my best friends are hard money lenders, and they use my techniques to go raise money for their hard money lending fund. So it's all the same money, right?
Yep.
But most of the time, a hard money lender is a broker to where they've gone out and raised money from ordinary people, right? They don't have to be accredited investors. They can be accredited investor. Oh, here, speaking of accredited investor, I'll come back to hard money and private money in a second. Here's what's funny.
Sure.
Very few of the 47 private lenders that Carol Joy and I have done business with are accredited investors. There's probably a handful, maybe 5 or 6 are accredited investors. But here's what's funny. None of those 47 private lenders even know what an accredited investor is.
Right. Yeah.
It's ordinary people with lazy money. But back to hard money and private money. Hard money lender is normally a brokerage to where they've gone out and raised money for their hard money lending fund. And so then the hard money lender loans that money out at a higher interest rate than what they're paying their investors in the fund.
Yep.
And of course, they charge points, origination fees, because they are originating the note. But private money, here's the simple definition of private money lender. It's a one-on-one transaction between the individual, the private money lender, and you, the borrower, your entity, your LLC, whatever it is that you're investing in. So there's no middle person involved. There's no origination fee to pay because there's no originator. Actually, you, the borrower, are the originator and not a middle person, if you will. So anyway, I lost my train of thought, but anyway.
Yeah, I appreciate that definition. It's important. And the distinction between the hard money lender's business and a private individual lending that money out, right? So it really is that private transaction. And just to kind of bring that back, you're talking about is is someone who is, again, rolled their money over to an SDIRA, is funding an opportunity that I'm funding your opportunity here of going to buy out single family home with, in this case, it's a rehab property, right? Lending on that after repair value number. So after the rehab has been done and it's whatever the value is there. So feel free to add more on here if you have more in that story. And thank you for taking us through that, because it's your life story, but it's also a wonderful narrative for the listener to understand, right? And that's, I know education here is really important to you. And so let's talk about that some more, right? We've talked about some incentives, quote unquote, we'll call it incentives of why the investor would want to do it. But are there other things that, you can share about why this makes such a great partnership between the investor and private money lenders?
It really, truly is a win scenario for both parties, the lender and the borrower. So let me speak from the lender standpoint first, the private lender. Here are some of the reasons that they really love the program. This is a way for a private lender to get involved in real estate and be totally passive. So they don't have to go negotiate deals. They don't have to find deals. They don't have to talk to sellers of properties. They don't have to oversee renovation projects. All they do is sit back and collect money. I mean, really, being a private lender is just like putting your money in the local bank. And instead of earning between 0.02% and maybe 3%, you're more than doubling that, maybe tripling what you can get. And so that's first of all, totally passive. Secondly, as I just alluded to, you make a whole lot more money, right? You make a whole lot more money passively. And then in addition to that, they love it because they don't have to worry about the volatility of their investment or the volatility of the value. So what I'm contrasting being a private lender to is investing in the stock market. My lands, as of today's recording of this show, has the stock market been a little volatile the last 3 weeks? You better know it's been volatile, right? And so the private lending, being a private money lender, gets rid of all the volatility aspect. You know exactly what the rate of return is going to be, just like putting your money in if you put in $100,000, if you're investing with me, depending on the deal, you're going to be making either $8,000 or $10,000 that year. And if you're using retirement funds, it's tax deferred or tax free. You're not even paying any taxes on that. And another reason they love the opportunity is because we have a way that in case emergencies come up, that they can get their money back early prior to the note coming due. And that's called a 90-day call option. So we put a 90-day call option in the promissory note that for whatever reason, it doesn't matter, if the private lender needs the money back early, then just give us a 90-day call option, give us a 90-day notice that you need to call the note due. And that gives us plenty of time to replace that private lender's investment capital with another one of our private lenders. We just do a refinance, cash out the current private lender, and replace them with another private lender. Now, most people that are doing private money, like myself, there's a penalty to call it due early. Like, if you call your CD early, certificate of deposit early at the local bank, you're going to pay a penalty. A lot of people charge 5% of the loan amount as a penalty if you call it due early. I don't do that. There's no penalty to call the note due early. I know in the real world, after all these years, I've only had 2 notes, small notes they were, called due early, and it was because of medical reasons that they needed the money. Private lenders, they don't want the money back. When they get the money back, they're not earning money. And so many of my new private lenders that have come on, I'll call them up. I'll say, hey, I've got a property at 411 Chatham Street that I've got under contract to sell. Just want to give you a heads up that you'll be receiving a payoff of your principal loan amount along with any unpaid accrued interest within the next couple of weeks when this cash is out. And invariably, the new private lender says, can't you just keep the money? And the answer is no. You can't keep the money if you're going to keep it collateralized by a property. Now, one thing I do a lot of, in fact, I did 2 of them yesterday. I do what's called, and this is sort of an advanced strategy, but I do a lot of substitutions of collateral. That's a type of loan modification. So if I've got a private lender that's got, money invested on property A, and I'm cashing out of property A, but right behind that, I'm purchasing property B, or I've got another property B that's got equity in it, then I can have my attorney draw up a loan modification / substitution of collateral that the private lender will have to sign off on, and they don't lose any interest. They don't lose 1 day of interest. The only thing that changes is the property that is collateralizing that note. And the private lenders love that because they keep earning interest without losing any money.
Yep. Yeah. And just flipping that over to I'll call it, in this structure, is it still fair to call them the operator side, the person who's finding the deal, or using different terms?
No, you can use the operators. Like I'm the operator. Okay. So like I'm finding the deals, I'm negotiating the deals, overseeing the renovation projects. Now, when I say I'm doing it, what I'm really saying is my team is doing it, right? I've had the same acquisitionist that negotiates with all the off-market sellers for over 20 years, right?
Very cool.
I've had the same project manager and general contractors for over 15 years. I've been working with the same realtor for over 20 years.
Awesome. And so for you guys and your team, obviously a well-trusted team who's been together for a long time, the other operators that you're teaching as well, right? You've got a bunch of stuff, you'll be sharing here shortly, is that from the operator side means continuous funds to continue to go out and do projects as well. What are some of the other benefits, right? And what I'm really asking and painting the picture here is, as we're walking through this, just to emphasize that this is a mutual relationship, right? It's really good for the investors putting their money to work, of course, being passive. We talk about on the show a lot, but also we talk about, the strategies that operators are doing. And this is a strategy to get deals funded. And you're talking about this from a rehab perspective, but mostly about getting the deals funded. So what are other benefits from the operator side here too? I know we talked about a bunch of them. I'm just trying to re-emphasize some of those. So access to funds, speed to capital. What else?
There's 20 of them, but I won't go over all 20, but I'll give the big ones. Let me drill down on what you just said. Access to funds.
Yeah.
The private lender and the operator, we are not regulated by the Commissioner of Banks. There's not all these hoops that the lender, the borrower have to jump through in order to adhere to all those governmental regulations. So access to funds, there is no limit to the number of private lenders or the amount of private money that an operator can have access to. As I said, Carol Joy and I, we've had 47, right? Private lenders investing anywhere from $50,000 to over $1 million spread over different properties. So scaling your business. When I was borrowing money from the banks, I had a limit to my line of credit. I missed out on deals because my line of credit was maxed out. But with private lenders, there is no maximum. You mentioned it, speed to capital. So on all my offers on properties, I offer to close within 7 days. Now,
very cool.
A lot of those properties are occupied. People can't get out in 7 days. But, another writer downer that, Steven, you and your audience have heard many times.
Time
kills deals.
Yep.
The more time that goes by between that initial conversation, going under contract, and then actually closing on the deal, all kinds of things can happen. So obviously on properties, and all the properties we buy are off market. None of them are in the multiple listing service. I hadn't bought a house out of the multiple listing service since before COVID because there's no deals in there. So everything we buy is off market. We use pay-per-click, pay-per-lead, direct mail, outbound calling, all kinds of ways that we find these deals. So I offer to close in 7 days. If the house is vacant, no problem. They want the money fast. Yep. But if they're still living in the property, Steven, I'm going to share something with your audience right now that anybody that's interested in real estate investing, this is worth, what I'm getting ready to say is worth you getting out of bed this morning. This is going to put money in your pocket. So what we do is we offer to close in 7 days. Obviously, if they're living in the home, they can't get out in 7 days. So I say, look, we'll close in 7 days and we'll give you 50% of your proceeds at closing in 7 days.
Nice.
And you can live in the house for free, no rent, for whatever length of time we agree on. And then you'll get the other 50% of your proceeds when you vacate the property in the length of time that we've, agreed upon. Speed, no limit to it. It's so simple. A closing has got about 5 documents: settlement statement, promissory note, deed of trust. I mean, my attorney's office is 12 steps down the sidewalk outside my building right here. Julie Wickheiser. She's been my attorney for 15 years, for goodness sakes. And so when I go do a closing, other than us having social chit chat, I'm done in 90 seconds. As opposed to institutional money, you're going to be signing a stack of papers like that. And so it's quick, it's easy, it's simple, there's no limit to it, and it's just a win-win for all parties.
Yeah, definitely. What are some of the things that you see as, this sounds great, right? I know it's great. I'm glad you're here to educate listeners about this too, and the audience. And so what I'm looking for here is to just contrast this for a second, right? Maybe not contrast, but what are things that could go wrong? Because we want people to be thinking of like, all right, cool, but there's risk and asymmetric, and we want to get as much asymmetric risk, as much upside and as little downside as possible. I know you have some resources to share, but what are some questions or things that you can mention right now and people should be thinking about? Like, okay, these are questions I should be looking for answers to make sure that I'm protected as well.
So let me point out a major risk for the borrower, and then let me point out a major risk for the lender. There's risk in everything we do. Exactly. Whether you're borrowing or whether you're lending, right? So let me start out with the borrower. One of the most popular scams on the internet, Facebook ads, etc., is supposed private lenders offering super cheap rates, 3%, 4%, offering to loan money on real estate. Guess what? When you respond to that ad or that post, they're going to ask you to send $2,000 to $3,000 application fee, and that's a scam. Never, and I know this personally from people that I know that have sent the money, and the money's never, they send their money, it's a scam. They're not going to loan you any money. So here's the deal. If you're looking to borrow private money, you never pay the private money any money until you close and they start earning interest.
Look, man, they're trying to contact you about your car's extended warranty, Jay. All right.
Right. So you don't pay money to borrow money, for goodness sakes. So that's on the borrower side. Let's go to the lender side. On the lender side, in this relationship, there's a 5-letter word that starts with T, and that's called trust. Important in this scenario. Now, are you being protected? Yes, on all those different ways. Conservative loan to value, It's not unsecured. It is secured. If the operator does not pay you, the property does. There's another writer downer. If they don't pay you, the property does, which means you get the property.
Love it.
And you should earn more money than the interest that you would have earned. But I know you don't want the property as the lender. That's why you're loaning money out. You don't want the property, but that is your legal recourse. Really what it comes down to is, even though all these protections are in place, the deed of trust for the mortgage, the conservative loan to value, all that, mortgagee on the insurance policy, really what it comes down to is, does the operator know what they're doing?
Exactly.
That's what it comes down to is, what's the operator's track record? If you're going to loan money to an operator that doesn't have much of a track record, who is their business partner that does have a track record, right? That maybe they're working with. So, quote unquote, know your operator.
Know your operator. Trust that makes sense. If you get your gut feeling, if this isn't maybe the right one, go look at the facts again, but also sometimes trust your gut.
That's right.
Right. Yeah. I have a question here, and then I really want to get to some of the resources you have here as well. But you've talked about people rolling over in this, that going back to the example we talked about of rolling over 150 from the 401k over to the SDIRA. What are your thoughts on loaning out that total volume, right? The total amount. What's kind of the guidance there? Do you think 50% of what might be in the SDIRA or more? Do you see where I'm getting at? Because that means the risk is, if I lose it all, I lose it all.
I think it's very wise to not have all of your eggs in one basket. So yes, I mean, I would definitely not. And by the way, I'm not an attorney. I never played an attorney on TV. I'm not a financial advisor, but just speaking from my own experience, I would never take my total retirement account and put it in one strategy. For sure. I want to keep. That was my problem. I had all my eggs in one basket in January 2009 with one lender. Speaking from the borrowing side kind of thing.
Yes. For your business, for your resource.
Yes, for sure.
And this is,
you want to spread your risk.
Got it. But for our fictitious example here and just talking about it, I understand what you're talking about. I'm not an attorney. These opinions are my own too. And sometimes I wear surf shorts, so you shouldn't listen to me on any of this stuff. Jay, appreciate you outlining this for everyone. I know you've had a lot of success here and obviously been going since 2009 or before. I think that was
2009 when I started using private money. 2003 is when we actually started investing.
There it is. Yep, what year is it? So at least 23-ish years, right? Very cool, man. Very cool. Glad to hear about all the successes, the impact to the many borrowers that you're educating, raising capital, and the lenders whose lives you've been helping out as well. I know you've got some resources and a conference coming up too. You mind mentioning those resources?
Absolutely. So I've got 3 resources, 3 gifts I'd like to give your audience, Steven. First is, I do 3 live events a year. It's called the Private Money Conference. Not another one like it on the planet. And it's held right here in Eastern North Carolina, Atlantic Beach, North Carolina, beautiful resort, oceanfront. And all the details as to what happens at the Private Money Conference, your audience can check it out at www.jayconner, and I'm an ER, not an OR. So JAYCONNER.com/event. So jayconner.com/event. It's a $3,000 event ticket price, but for your audience, Steven, we slash that down to only a $97 registration fee that reserves a seat, and they get to bring a guest as well. Secondly, I'd like to offer your audience my national best-selling book, which is called Where to Get the Money Now. Where to Get the Money Now. And the subtitle is How and Where to Get Money for Your Real Estate Deals Without Relying on Traditional or Hard Money Lenders. And again, with the book, it comes with the 2 tickets to the Private Money Conference. I'll autograph it for you and ship it out express mail. So that'll come to you in your mailbox. And then thirdly,
Appreciate that.
a free downloadable PDF. I just recently wrote my 12 different private money $1 million scripts. And the first one is called the Curiosity Opener. One of the most common questions that I get from real estate investors, operators that want to raise capital is, how do I start conversations? Like, how do I even bring up the subject to where I'm not sounding desperate and all that kind of stuff? So you can download that free script at jayconner.com, JAYCONNER.com/scripts. And that's plural, jayconner.com/scripts. And that'll come right to your laptop or your phone.
Awesome, man. Yeah, super cool. I'll make sure we get those in the show notes as well. I think these kinds of things are, whether you're lender or borrower, are just good to know. We're all about taking ownership, educating ourselves here, and really understanding not just, the resources we have, putting those to good use, but the resourcefulness and being stewards of those as well. So I think this falls in line just to continue to expand our education. So Jay, man, thank you so much for being here. I wish I had learned about private money many more years ago. I was born in 1989, just so you know. So 4 years earlier than when you started. So thanks for sharing your knowledge here.
Steven, thank you so much for having me on.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in the future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.